Alright, hello guys and glad to have you on board again today. We're going to make a daily update because I think yesterday was one of these sessions that sent a message, and that the message that's been sent might be interesting and worth a record because I think it's going to move things in higher time frames. Okay, so of course these will need to be confirmed. That's basically the stance that I shared over the weekend update in TradingView, telling you that we definitely need some validations over the higher time frames, daily ones specifically, for stock markets. So we're definitely not yet there at the current given time. Yesterday has been a rebound session as expected, of course, but we are now jiggling with the risk limitation areas, which I think are definitely going to hold as resistance. We'll see all about that, of course, because this is still speculative at that point. I expected the market to rebound to third range boundary territory. This is what we're doing. You have details of the plans on the weekly update for the stock market on TradingView. Despite that, that's not the case, and that's not what I want to talk about today. These things have already been documented, so I'm not going to repeat myself. What basically is the topic today is to understand that if we're heading toward validation, this is what I look for as side validation stuff. What are the things that I think will help us understand what the next big move is? I'm talking about the swing move, okay? We have hesitating market all across the board post-COVID. The market braced for the best and now understands that we are not getting what we wanted. We don't have a full recovery. We have something weird, something that isn't playing as best as we thought it would. We're not out of the pandemic, definitely not. The virus is still there, it's evolving, and the crisis is definitely not over. I think the pandemic part of the crisis might be over, or at least reaching to its end. And that's a pretty optimistic statement, to be honest. I'm definitely not a medicine to talk about it. I'm not a specified guy, so I'm not going to go down this road, okay? What I'm going to say is that, considering that it's settled, it might be the stupidest thing to do, because it's not, and we still have very complex economical reactions to the virus in the pandemic stage. Still, what I like is to try figuring out what the next market's move is going to be, okay? So generally what I like to tell you is that when hesitation is around, normally you should see ranges. Of course, that's not what we've had. We've had downside trends recently on cryptos. When I say downside trends, I'm talking about short-term charts, okay? They definitely have switched to bear territory. But of course, the longer-term chart time frame still holds on to the bullish stance. So we have a fight, we have a range, okay? So cryptos are ranging. They're just ranging crazily fucking stupidly volatile, but they're ranging. They are some asset classes that do not range, like DXY. We're ranging, no problem. We've trended after the COVID, but we've ranged and digested things so far. We'll talk about this guy later. Okay, we're ranging on yields. We're ranging on silver and gold. We're not ranging on WTI, so there has been a trend trade, and we're going to talk about this guy. And these guys are not ranging trading as either. They're trend trading. We've assessed the problem that these guys are mostly trending just because of 5 to 10 stocks. So there's a problem of market breadth. And if you remove these stocks, pretty much everyone else has been ranging. Of course, this range has shifted seriously to the upside because of monetary injection and the base effect of monetary basis. But despite that, if you just removed all of the money that has been printed, we should see valuations ranging. And that is exactly what we should do now. Now that we've printed money, the question is, how long are we going to keep printing that money? Because remember that what the market cares is not how much money is printed. The market cares about the momentum. We've increased severely the asset purchases and stuff like that, which caused prices to severely increase even if we were right in the middle of a fucking pandemic. The market anticipated the printer going brrr. Now that the printer has gone brrr, and it's still actually doing it now, market is just caring about one thing. How is it going to slow down? Because we've accelerated significantly to a stage that it is now unsustainable without creating real economical problems. to so-called inflation. So the inflation topic and the inflation trade has been the center of the maze, and therefore it is raising questions on how and when are we going to start normalizing monetary policy. So this is one part of the problem: monetary policy, COVID, and of course inflation. So these are the three major stuff. We have risks of inflation in the real economy. We do have monetary policy who has fueled this inflationary pressure and might be trying to slow them down by tapering. But we also have the third part of it, which is the damned COVID, which can act both on real economy and can also orientate monetary policies, because of course the Fed simply doesn't want to stop the cocaine operation, and as it is, they just want to keep it flowing as long as possible to avoid creating a market crash due to tapering monetary policies. So having tensions over COVID is by far the best thing the Fed could try to play, saying that the pandemic is not over, that we need to keep on purchases, and they will try to slow down the inflation on the real economy, which is going to be hell of a trouble, okay? They will say probably this is government purposes stuff, whatever, okay? But we'll see all about that. These are definitely complex topics, though we should see ranges. So I'm really concerned about all of the asset classes that are not showing ranges, because I think they are lying. That's the reason why I told you not to pile into WTI and certainly not to pile into the big names. I'm fighting against this trade, but I damn know how complicated that is to counter trend trade these crowded things. But still, don't get into them. They're pretty damn over mature now. So what I care now is to have a look at all of those who have been ranging since then, specifically the XY and yields. I think that it's worth looking at gold and silver as well, because they've made quite some nice ranges. So this is where my current attention is driven to. I'm definitely looking at these guys. I'm trading these assets with speculative positions, but I'm mostly caring about the breakout trades now, because just look at that, okay? Mature range, triangle looking like, DXY, same thing, mature range, triangle looking like, and 10-year yields, not ranging yet, but we have severely reversed the current bear move that has been exhausted with COVID pandemic. So I think that we are creating some kind of a head and shoulder pattern in here. Just needs a bit more time to validate, but we will have a long-term reverse on yields. What we've experienced with the COVID is the end of the printing cycle. That doesn't mean that we will terminate it now. All that means is that throughout the course of the next few years, I'm definitely standing for what I said. I'm talking about years. I don't know how long it's going to take. All I know is that the next move is to break yields up. We're not going to go negative territory because the bond market will never accept such a thing. So the thing is that there is a rock bottom structure now, and we are standing below it, but I doubt we will do much longer. We're probably going to oscillate across this level for a bit, but normally the range in the bond market is between 3% and 0.5%. But knowing the fact that we're very less likely going to be able to hold below 1.30. Reason why we might be standing for prices in between. This is the DOM zone, okay? This is the DOM zone of this range. So we can stay there for a little while, but I suspect anyhow and anyway, reaching out for these more average prices, not necessarily reaching 3%, not necessarily breaking these previous high points, but at least reaching for the moving average seems like anyhow and anyway the next trade for yields. So yields might be pushing higher. So whether you like it or not, even if the Fed tapers or not, we will get higher rates. Even if the Fed never raises interest rates, at some point, people will start asking for higher rates to lend to people. It's just how it works. Lending and borrowing is a risk collateral system, and it's not the Fed all by itself that defines what the risk measurements should be. At some point, the confidence market makers have in the Fed will just disappear. They will say, all right, you're not rational enough, we're going to do the job for you. Don't forget that the Fed sets the basis interest rates. The interest rates themselves remain uncontrolled by the Fed. These are private banks who do this thing. Right now, it is a stupid puppet game that we're playing and that we've played for years. Play along with the Fed and you'll be fine and nice with credit accounts, reverse repo operations, and all of the cocaine stuff that has been driving market prices up for decades. But these systems are now getting out of order. It is pretty much the end, but we're talking about decade-long trades. So it can take up to half a decade, I think, to reverse this stance. And we can stay there for quite a long range. But right now you need to understand that the range is not between 0.5% and the latest high points we've made. The range is between 0.5% and 3%. So we much more are attracted to the upside rather than the downside for yields. The dollar is where I think the most interesting trade could be within the next few days. We have this mature triangle, and I very damn think that the breakdown is the likeliest outcome out there, because we've reversed this as a bear triangle. We totally failed to hold candle close. This is just base effect of the COVID. As you can see, this is due to volatility. So we've handled a single candle close beyond the context, and the next one has been a bearish engulfing. So that is generally what we call a fake breakout. So we have a fake out. We've never stood value over the resistant context, which means we've reversed inside the resistant context, which means we have a bear range. We are supposed to trade below these lows, which means there is traction for prices to get into this territory. Oh, clap. This is where we've got the high time frame context, by the way. So this is where I think we're heading next. Question there is, how fast are we going to get there? But the range is now mature, which means trend following continuation to the downside feels like a probable move. So I'm definitely looking at signs for these moves to show up, because if they do, that means we're pulling back into the inflationary pressures, okay? Printing money and so on. That can be due to multiple stuff, either because the Fed refuses to taper and they're going to use the COVID excuse to keep printing, even if that means overheating the economy with dangerous inflation levels. They will do whatever the fuck they can to keep printing, because they just don't want to be the ones that ruin the party, which is understandable at some points, but questionable in terms of job. I mean, their job is not to think about what they will do, is to just do what has to be done. But anyway, so that's a topic for another day. Then we have to move for these crowd trade, which I think in here, try to think about the range. Where would be the next support for this thing? Because right now, everyone just says, all right, we still have plenty of room. Just like I said, we have no more room. We've already reached out the targets at some point. So what's left for us in here is the range. And I damn think that the range is going to settle, like every range does, in between the trend channel. The trend channel is currently trading at 44. I doubt we will get there in a straight line, but once again, don't forget that this is still possible. We've piled up quite some risks about betting on a huge V-shaped recovery that we don't get. We've gone for a K-shaped recovery, which means only the rich guys have managed to make some money over the crisis. The others just lost heavily amount of purchasing power, and they will figure it out sooner rather than later, because inflation is what's going to drive these more than anything else. Okay, so we're going to see the consequences of the K-shaped recovery pretty sooner rather than later. And this is why I think there might be a bit of a problem. Also, not to mention that if COVID rolls out of control for some reasons, because we do not control anything yet, that could flush out some eventually partial lockdowns or so on, and that would definitely be good for WTI. So we'll see all about that. Worst case scenario, we would be retracing down to these prices. What matters now is that this is reverse trading, can only be done with experienced trading capacities and definitely nothing else. Normally we're supposed to range below the current asset value, which means I currently expect that until the next quarter's ends, okay, so this is the end of September, till the end of September, I think that we might be dipping toes below 48. I also think that this is not necessarily going to happen. We could just slow down, release the gains with constructed downside price action till September. And in September, of course, these valuations will keep increasing, but we're going to have to dip a toe below this line. Okay? The range on this mature will very likely give us another trend following opportunity, but those who are trend following now, with overheating trend means they're taking some dumb risks. Okay, same thing goes to me into stock market, in which everyone think that this is not the end. Let me be real honest, the weekly signals we have are definitely fucking concerning, and I'd rather like not to bet to the upside now. So same thing goes in here, reverse trading for experienced traders only. Shorter time frames are okay for third range boundary territory trade. As you can see, we are definitely trading above the resistance context with candle closes and so on. So this is at best a neutral range. We always trade above the resistance context, and this is also the reason why currently I'm looking at what prices are doing. I'm already short selling the indices, just plain simple. This is my stop loss size. I'm following the goddamn strategy, okay? So as of right now, I'm cautiously looking at this market behavior. I doubt we will squeeze the third range boundary. I just think we're going to brace for a neutral range. So I'm waiting for this range to mature. When the neutral range will be matured enough, either we break it to the upside to restore the trend's behavior, or to the downside to confirm the daily reversals, okay? So I don't expect trends to show up in the stock market now. What I expect instead is more like a range, probably looking at what I have in front of me, going to be a neutral range. So I expect lower high points, but also higher low points, kind of a convergence structure, triangle, whatever the fuck you want to call it. I just think this is the likeliest outcome, okay? So waiting for ranges to mature, which means waiting for a third range boundary to build itself, waiting for a fourth one, and then we'll wait for breakouts up or down, and that will tell us what needs to be done next for the stock market. Okay, pay a real good attention to the top 10 stocks specifically, because the market is already ranging everywhere else. Okay, market participation is due to just a few stocks, and we have immense distribution pattern currently going on Apple. Okay, remember that this is the exact same thing people forgot about in Bitcoin. Okay, everyone think we're going to go for this trend line. Let me be damn sure that we're probably not going to, and I very well expect that we're going to reintegrate the previous range, cross it all across the board, range a bit, and then flush the money out. So I still am quite bearish on Apple, but that doesn't mean you have to. This is like fighting against a bubble. So this is something none of you guys should do. Okay, despite that, like I said, don't buy the shit. Do whatever the fuck you want. Buy whatever the fuck you want. Just don't buy the crowded trades. That's the stupidest mistake you could make. All right, despite that, that's going to be it for today. Of course not. We're going to talk about cryptocurrencies. So the cryptocurrencies have made some kind of a dip yesterday. I still believe it is hard to figure it out as a true validated bottom structure and so on, but I still also believe that it was done to short sell a support. So we're rebouncing because of no one selling. But what I like in here is that this might be the first time we are actually rebouncing without breaking the support. So the ranges in here might have been mature anyway, so even if we broke down the support, we would just have built some temporary bottom structure with lower low points. Still totally favorable to the upside anyway in the end, building some kind of a wedge pattern like that, okay? But like I said, we are not in regular technical structure. We are in psychologically assessed markets. And to be goddamn honest, I think that everyone's forgetting about the most important thing is that we do not have to get there. We just have to see people thinking that we have to, and then we'll reverse on the support. So I will not say that we have a reverse. All I could say is that we are squeezing the momentum, and in order to fully say that we have succeeded, I want to see valuation crossing the goddamn 50% value, okay? So until we get right up there and settle for candle closes, this is the same old $1.6 trillion area. There is no such a thing as a confirmed bottom, okay? So you can do whatever you want. I personally don't give any credit to what's going on now. I'm not making margin trading anymore because it's too dangerous. Prices can do some stupid stuff out there, okay? And most importantly, if we ever have volatility over stock market, people will make the stupid gamble saying that volatility will have to show up in cryptos as well. There is no such a thing as the correlation between stock markets and crypto markets, because we have this. In this current period, we had cryptocurrencies falling off the goddamn cliff when the stock market kept going up, which means a decorrelation pattern has gone to play. And normally we follow the same old structure, which means now we should have a slow but still existing recovery, where we should have a fast drop in asset valuations in indices to recorrelate, and then we'll see if both are going down or both are reactivating to the upside. But until then, I still favor cryptocurrencies to go back to neutral, just like I think the stock market should go back to neutral as well, because everywhere else we're ranging because we have too many options regarding COVID's uncertainty, monetary policies uncertainty, real economical overheating pressures, and all of these things that suggest that, in my personal opinion, stagflation is the outcome for this post-COVID pandemic. And in that perspective, stagflation creates range in the stock market. Not a bull market, not a bear market, just pure boring ranges. Okay? So as usual, don't try to be trend trading in a range. That's the dumbest mistake to make. Sell high, buy low, and most importantly, try to find some momentum. In order to get the momentum, try to find stocks that can create it. Same thing goes for cryptos. Don't spread your money into dozens of assets, but don't concentrate too much into just a couple. Okay, I think like 10 stocks in the portfolio is a bare minimum, just like 10 cryptos might be good. Don't go for 50 stocks in the portfolio and 50 cryptos. I think that's a bit too much. Something like between 10 to 20 is, in my personal opinion, a good stance to be in. Okay, that being said, I'll wish you guys a pleasant day. Trade smart, don't trade too much, be patient enough to wait for value trades to show up the direction. But until then, if you are margin trading in a market that lacks of liquidity and that lacks of breadth, you might be learning another hard lesson that I've learned back then myself as well. Prices don't tell the story every time. There are moments in which prices lie, and if you keep on following these lies, you'll be the one to pay for the consequences. That being said, just be cautious and reduce leverage if you do trade with margin. That's the only thing I'm saying out there. Bye, guys.